G'day legends, welcome back to the Gold Jumper channel, the only place where we track the shiny stuff and the mining gains. Jump up and under, let's get into it, because the market has been absolutely flat out over the last 3 days of March 2026. In this video, we're recapping the gold price recovery between March 24th and March 26th, 2026. We'll be checking out the massive rally in Aussie mining stocks compared to the absolute carnage in the US tech sector. Plus, we're diving into the technical indicators like the RSI and the Bollinger Bands to see if this bottom is fair dinkum. Before we start, a quick disclaimer that I'm not a financial advisor, so always do your own research before jumping into a trade. The big question today is, has gold finally hit its floor, or are we about to see another plunge below $4,000? Tell us your thoughts in the comments below, legends, and remember to smash that like and subscribe button for the latest updates. First up, we have to talk about the geopolitics in the Middle East that's keeping the whole world on its toes right now. The Strait of Hormuz is basically a bottleneck at the moment, with about 20% of the world's oil supply under threat. Back on March 19th, strikes on an LNG complex in Qatar knocked out 17% of their export capacity. This Hormuz Shock sent shockwaves through the markets, but the last 3 days have seen a little bit of a reprieve. On March 24th, President Trump delayed planned strikes on Iranian energy facilities by 5 days, citing positive talks. Tehran was quick to call that psychological warfare, but it gave the gold market a much-needed breather after a massive slide. By March 25th, news leaked about a 15-point peace proposal sent from Washington to Iran through Pakistani mediators. The proposal includes nuclear curbs and keeping the Strait of Hormuz open in exchange for ending those nasty sanctions. Now, let's look at the energy markets because the price of oil is playing a massive role in the gold price right now. WTI crude oil has been on a roller coaster, hovering around $91.50 per barrel as the tensions simmer. High oil prices are bad for gold because they keep inflation high, which means the Fed isn't going to cut rates anytime soon. The OVX, which is the Oil Volatility Index, was sitting around 89.3 on Tuesday, which is exceptionally high. When energy volatility is this high, it creates a geopolitical paradox where gold actually gets sold off to cover losses elsewhere. Institutional traders have been liquidating their gold positions just to raise cash for margin calls in their failing stock portfolios. Traders are literally selling their winners to pay for their losers, and that's why gold hit a 4-month low earlier this week. Struth, it's a messy situation, but as the oil price stabilized on Wednesday, gold finally found some room to bounce back. Looking at the price action from March 24th, gold opened around $4,413 per ounce. It was a wild session, with prices swinging down to $4,306 before closing near $4,474. On Wednesday, March 25th, the bulls finally took control and pushed the price up by nearly 2%. Gold hit an intraday high of $4,602 before settling back at $4,557. This rally was fueled by those de-escalation hopes and a slight softening of the US dollar index, which fell below 100. Coming into today, Thursday, March 26th, gold is consolidating its gains and holding steady around $4,541. The market is basically waiting to see the latest macro data from the States before deciding where to jump next. Don't sweat the dip, just more room in the pouch, because even with this drop, gold is still way up compared to last year. We're still seeing a massive difference between the paper price on your screen and the actual physical price of gold bars. Physical premiums are still sky high, meaning the real demand for the metal is still there, even if the screen price looks a bit cactus. The US macro landscape is also weighing heavily on us, with the DXY dollar index sitting at 99.46. Even though the dollar had its worst year since 2017, it's still getting a safe haven bid because of the energy crisis. Today, we're also keeping a sharp eye on the US weekly jobless claims, which came in around 205,000. This shows the labor market is still pretty resilient, which gives the Fed more excuses to keep interest rates higher for longer. We also have the S&P Global Flash PMI data coming out, which acts as a major catalyst for the gold price. If the data comes in strong, the dollar will likely climb and put more pressure on gold in the short term. But if the PMI is weak, we could see a massive short covering rally that pushes gold back toward $4,600. The Aussie dollar is also in a tight spot, struggling to stay above 71 cents. A weaker Aussie dollar actually makes gold more expensive for us back home, acting as a natural hedge for local investors. It's a bit of a balancing act, but the overall trend for the greenback is looking tactically bearish as we move through 2026. Now let's talk about the ASX versus the S&P 500, because there is a violent rotation happening right now. The ASX 200 hit a 10-month low of 8,262 on Monday before staging a massive comeback. By Wednesday, the ASX 200 jumped over 1.8% to close at 8,534. This was our strongest daily gain since February, and it was mostly driven by our world-class mining and gold sectors. Meanwhile, over on Wall Street, the S&P 500 is down about 1.9% for the year so far. Investors are ditching the expensive tech giants and looking for value in more traditional spaces like commodities and materials. It's a complete reversal of the last few years where tech was the only game in town, and now miners are stealing the spotlight. For Aussie investors, this is great news because our market is heavily weighted toward those solid resource companies. The ASX 200 still needs to reclaim its 200-day moving average at 8,776 to confirm the uptrend. But the capitulation signs we saw on Tuesday suggest that the medium-term low might finally be in the bag, legends. Let's do a deep dive into the Aussie gold miners because they are absolutely storming higher right now, and it's a beautiful sight. On Wednesday, the ASX Gold Index surged over 8%, led by a massive gain from Evolution Mining of 8.5%. Northern Star Resources jumped up to $17.55, gaining about 2% in a single afternoon. Newmont was also on fire, adding 4.8% to reach $138.10 per share. Genesis Minerals was the standout performer, jumping over 6% to $5.69 on the back of gold's recovery. These miners have what we call operational leverage, which means when gold goes up 10%, their profits can jump 30%. But remember, that leverage works both ways, so when the gold price dips, the miners usually get hit 3 times as hard. Evolution Mining is currently trading at $11.86, and it's looking like a favorite for those buying the dip. Gold miners are currently trading at very low valuations compared to their earnings, with some sub 5 times forward earnings. This makes them a very attractive alternative to the overvalued tech sector, especially as de-dollarization picks up the pace. Speaking of tech, the Magnificent 7 stocks are having a rough trot in 2026, dragging down the whole US market. These 7 companies, like Microsoft and Tesla, make up a whopping 33% of the total value of the S&P 500. Microsoft has dropped over 17% this year, while Tesla is down 11.3% as the narrative shifts. The earnings growth for these tech giants has basically been cut in half compared to the glory days of 2025. Now that their growth is slowing down, investors are realizing they don't want to pay those lofty valuations anymore. Nvidia and Alphabet are still trying to hold the line, but every single one of the Mag 7 is underperforming the broader index. If the Magnificent 7 drops another 5%, the rest of the market has to gain nearly 3% just to stay flat. This concentration is a huge risk for anyone just holding a standard index fund without any exposure to hard assets. We're seeing a rotation into value-oriented spaces, and the other 493 stocks are actually holding the S&P up. It's a tough environment for tech bros, but for us gold jumpers, it's exactly the kind of shift we've been waiting for. Even the legends over on WallStreetBets are starting to feel the heat, and the sentiment there is getting pretty bearish for tech. There's a lot of talk about a short ladder attack incoming, and traders are bracing for an extinction-level event for call options. Reddit users are making memes about supply chains being totally disrupted and the logistics being in absolute shambles right now. The phrase, unexpected headwinds, is being used by every CEO to explain why their earnings are looking a bit average. Some traders on the sub are holding SPY puts, betting on a major crash as the energy crisis and high interest rates bite. There's also a focus on legal shocks for the tech giants, with Meta and YouTube facing massive fines over social media addiction. While the memes are funny, the underlying sentiment shows that retail traders are starting to hedge against a massive tech correction. Some are even suggesting that gold miners are the obvious buy of 2026 because of the structural shifts in the world. They're realizing that the US dollar isn't the only game in town anymore, and gold is the best alternative for long-term trust. Good on your Wall Street bets for finally seeing the light and realizing that you can't print more physical gold. We also need to mention de-dollarization, because it's a massive long-term tailwind for everything we're talking about today. Central banks are systematically reducing their reliance on dollar assets and moving into gold at a record pace. The BRICS nations, led by China and Russia, are now responsible for about 40% of all global central bank gold buying. New buyers are appearing too, with central banks from Malaysia and Indonesia joining the party for the first time ever. Even if the high prices make them slow down their buying a little bit, the strategic shift away from the dollar is permanent. The dollar's share of global reserves is projected to fall to around 54% this year, continuing a long-term decline. Gold is being seen as a strategic instrument that has no credit risk and can't be weaponized like a traditional currency. Analysts believe that even a tiny shift from treasuries into gold will create persistent upward pressure on prices for years. This inelastic supply is the secret weapon for gold bugs because mine production simply can't expand fast enough to meet demand. So while the paper traders are flushing their positions, the central banks are quietly stacking the floor for the next leg up. Now, for the bit you've all been waiting for, let's dive into the technical indicators for gold as of March 26th. On the daily chart, the RSI is currently sitting around 27, which is deeply oversold and hasn't been this low since 2024. This usually points to a major relief bounce being imminent, as the selling pressure has reached a point of absolute exhaustion. The 50-day moving average at $4,960 is now our major overhead resistance to watch. Down below, the 200-day exponential moving average at $4,200 is the bull-bear line in the sand. Price is currently riding the lower Bollinger Band, and the bands are expanding, which tells us that the volatility is very high. We haven't seen a death cross yet, but the 50-day average is trending lower, toward that 200-day line, so watch out. On the 4-hour chart, the parabolic SAR dots moved below the candles on Wednesday, giving us a short-term bullish signal. Immediate support is at $4,286, while the first resistance target is at $4,597. If we can break and hold above $4,600, the next big hurdle for the bulls is the $4,700 mark. Remember that the gold price on your screen is set by the paper market of futures and ETFs, not just physical metal. When the dollar spikes, leveraged paper traders get squeezed and have to dump their gold to meet margin calls on their books. This is what we call a paper market flush, and it has nothing to do with the fundamental value of the gold you hold. On the news of the Hormuz threat, gold actually spiked up to $5,400 before crashing 6% in a few hours. This volatility is noise for long-term stackers, but it's genuinely dangerous for anyone using too much leverage in their trades. The structural reasons gold ran from $2,600 to over $5,000 in a year haven't changed one bit. We still have massive US fiscal deficits, a hot war in the Middle East, and central banks that can't get enough of the metal. Major banks like JP Morgan and Deutsche Bank are still targeting $6,000 or more by the end of the year. So even though the technicals look a bit battered right now, the long-term bull market is still very much intact. Legends. The 50-day moving average is the pivotal resistance, and once we reclaim that, the bears will be in for a world of hurt. So, to wrap it up, gold is fighting back after hitting $4,097 on Monday. The Aussie miners like Evolution and Northern Star are leading the charge and outperforming the broader market by a mile. Middle East tensions are still the main driver, with oil volatility and the OVX making everyone a bit jumpy. Technicals show we're deeply oversold on the RSI, which usually means a solid relief bounce is on the cards soon. Tech stocks in the US are weighing down the indices, while value stocks and miners are starting to shine. Central banks are still stacking gold behind the scenes, keeping that long-term structural floor nice and solid. Don't sweat the dip, just more room in the pouch, because the structural bull run for gold isn't over yet. What's your move for the end of the week, legends? Is the bottom finally in for the shiny stuff? Let us know your price targets in the comments, and if you're buying the Aussie miners at these levels. Hit that like button if you enjoyed the recap, and subscribe to join our community of legendary traders. Stay active, stay legendary. Catch ya!